Welcome to episode 6 of Bookkeeping for Small Business Owners. This will be our final episode, and we're going to cover the capstone of our pyramid of knowledge, which includes the accounting cycle and the bookkeeping cycle. After that, we will finish off our series by putting everything together with one final grand example. First, hi, my name is Christian. I'm the owner and chief bookkeeper here at Vitality Bookkeeping. If you're interested in getting your books taken care of, I'd be happy to help. Just visit my website, vitalitybookkeeping.net. At this point in the series, we've covered all the fundamentals of bookkeeping. You know what it is, how to do it by recording transactions and updating the books, and then what to do with that information by creating financial statements. These financial statements, of course, being the end goal of bookkeeping. So, that being said, it's time to put it all together. First, we'll learn the official accounting process, called the accounting cycle, and then we'll learn the full bookkeeping process, called the bookkeeping cycle, which will then complete the course. Important note, you don't need to learn the full accounting cycle. You do need to be familiar with it for the bookkeeping cycle, though. Don't worry though, I've summarized some parts down so that you still get the full picture of the accounting cycle, but we're able to be efficient with our time. So, with that, let's get started. What is the accounting cycle and how do you use it? The accounting cycle is the standard 8-step process that takes an accountant from disorganization to fully updated accounting. The steps are as follows. 1. Identify transactions. 2. Record transactions to the general journal. 3. Post journal entries to the general ledger. 4. Create an unadjusted trial balance. 5. Make any adjusting entries. 6. Create an adjusted trial balance. 7. Create financial statements. And 8. Close the books. Many of these steps may seem familiar because, as mentioned in the past, the bookkeeping cycle is actually part of the accounting cycle. All that said, let's start with step 1. Step 1. Identify transactions. Up to this point, we've talked about recording transactions, but haven't really touched on where these transactions come from. We've just been using made-up examples. So where does a business find the transactions it needs for bookkeeping? The answer is bank accounts and credit card accounts. When it comes to bookkeeping and accounting, you find every bank and credit card tied to the business, and then go line by line and collect the transactions. You also need to collect all relevant statements and documents, like loan statements, that might be necessary to help explain these transactions. Step 2 and Step 3. Record transactions in the general journal and then post them to the general ledger. We, of course, covered this last episode in episode 5, so review that if you wish. Step 4. Create an unadjusted trial balance. What is a trial balance? A trial balance is just every general ledger account listed out next to its balance. When every ledger account is listed out like this, it'll show every debit and every credit total in the business. The purpose of a trial balance is to show that when you add up all the debits and all the credits, they should be equal. The reason they should be equal is because of the accounting equation. When you've listed these accounts out, and you add them up, and you see that total debits equal total credits, then you've created an unadjusted trial balance. By ensuring total debits equal total credits, you show that the books are balanced. In modern software, where you're likely to do your bookkeeping, trial balances will be done for you automatically. Step 5. Make any adjusting entries. In accrual, not cash basis, but in accrual bookkeeping, there are times when the timing and amounts of a transaction don't line up with what actually happened in the bank and credit card accounts. When this is the case, adjusting entries need to be made. Since we're learning cash basis, we don't need to worry about this step. Step 6. Create an adjusted trial balance. Likewise, since we're cash basis, we don't need to adjust anything, and so we can skip this step as well. Step 7. Create financial statements. After making sure the books are balanced with the trial balance, you then create financial statements, which is something we covered last episode in episode 5. Step 8. Close the books. If you recall the time period principle from episode 1, you know that accounting is done over periods of time, whether annually, monthly, quarterly, and so forth. When one of these periods of time ends, the books must be closed. This is so the information can't be changed after the fact, and so that a new period can start fresh. Closing the books can be complicated, but for a cash basis small business, you more or less just need to bring the expense and revenue accounts down to 0. The reason we bring them down to 0 is so that we have a clean slate so we can have a fresh profit and loss for the next period. Much like trial balances, modern accounting software will close the books for you. But just for the sake of learning how to do it properly, let's figure out how to close the books. To zero out the revenue and expense accounts, go to your general ledger for that time period and list out every revenue and every expense account used in that period, as well as their associated balance for that period. In some ways, this will look very similar to an income statement. We'll use the balances from episode 5. If you recall the accounting equation, you'll know that revenues and expenses are both subcategories of owner's equity. Closing out the revenue and expense accounts involves transferring their balances to the retained earnings account for that period. We transfer the retained earnings to, as you might imagine, keep track of what the owner has earned or lost in the business over time. For each of the listed revenue accounts, debit the account for their period balance and credit that balance to an account called retained earnings. For example, for hypothetical revenue number 1, we would debit it for its full amount of $850 and credit retained earnings for that amount, zeroing out hypothetical revenue number 1 and updating retained earnings. Remember that retained earnings is an owner's equity account and therefore a credit normal balance. Next, for each expense account used in that period, credit its final balance and to debit that balance to retained earnings. For example, if hypothetical expense number 1 had a $120 balance, you would credit hypothetical expense number 1 for $120 and debit retained earnings $120. For our example, we'll repeat this until every expense and revenue account is zeroed out. At the end, you can see near the bottom that our retained earnings is $790. As highlighted earlier, by closing revenue and expense accounts for the period into retained earnings, you add that period's net income or subtract that period's net loss from owner's equity. After doing this, your books are prepared for the new period and you can literally close your books if you're doing physically or digitally if you're doing them with software. Alright, that's the accounting cycle. That's the full cycle an accountant would go through if they were tasked with doing the accounting for a particular business. This course, however, is about bookkeeping. So now that you've been introduced to the accounting cycle, we can now focus on what you really need to learn. It's finally time to learn the official start-to-finish process of bookkeeping, the bookkeeping cycle. The bookkeeping cycle is the full approach you will use when doing bookkeeping for your business or if tasked with doing the bookkeeping for another business. The bookkeeping cycle takes bookkeepers from disorganization to having fully updated books along with their accompanying financial statements. This isn't necessarily something you'll find in a textbook, so much as this is the way professional bookkeepers generally handle a client's books. The bookkeeping cycle consists of 5 steps. Step 1, set up the books. Step 2, categorize transactions. Step 3, reconcile accounts. Step 4, create financial statements. And Step 5, close the books. Step 1, set up the books. Setting up the books can differ a bit depending on where you or your client keep their books. In 2025, the vast majority of books are done in accounting softwares like QuickBooks Online. That said, the setup will be very similar regardless of where they're kept. Let's break down Step 1 into a series of sub-steps. Step 1.1. Identify all of the bank and credit card accounts used in the business. As you know, in order to do bookkeeping, you need access to the business's transactions. And you get access to these transactions by looking into the bank and credit card accounts. You identify the accounts with 3 details: the name of the company, the type of account it is, and the last 4 digits. For example, Chase Business Checking 6174, American Express Credit Card 7368, and so forth. Step 1.2, get transaction feeds for these accounts. In modern software, you would simply connect the bank and credit card accounts with a service called Plaid and get a live transaction feed. If that's not possible, then you would need to either log into the account itself and look at the feed on their website, or get a copy of the account statement whenever it's released. Banks typically issue their bank statements at the end of the month, and credit cards will typically vary within the month itself, usually around the middle. Step 1.3, create a general ledger and a general journal. If you're using an accounting software, these are generated for you. If you're not using a software, you can pull out some notebooks and start writing things out by hand. Or you can open up Excel or an Excel equivalent and create a ledger and journal from there. For the journal, you just need a way to track each transaction with the 5 details we discussed in episode 5. And for the general ledger, you need a centralized location to transfer these entries to. Step 1.4, create a chart of accounts. After getting access to the bank and credit card account feeds, you can start to create a list of ledger accounts to categorize the transactions into. This will be a basic list made up of accounts like service revenue, office supplies, and so forth. You'll create more specific accounts as you do the bookkeeping, but it's good to have a basic list before starting. As a quick tip, I also recommend giving each account a number so that the chart of accounts is easy to search through later. Step 1.5. The final step of setting up the books is customizing the books for your business. This means writing down important details that are specific to your business. Things like the name of your business, whether you're cash basis or accrual basis, what the fiscal start of the year is, opening balances for any accounts, and of course what the fiscal end of the year is. After adding this information, you've completed setting up the books and thus have finished step 1 of the bookkeeping cycle. Once again, the sub-steps to setting up the books are: identify the accounts used in the business, get access to their transaction feeds, create a general ledger and a general journal, create a chart of accounts, and customize the books. Step 2 of the bookkeeping cycle, categorize transactions. Categorizing transactions makes up the bulk of bookkeeping work. In fact, this is where you'll apply most of what you've learned in this course. If you remember the acronym MAC, M-A-C, as well as the other 2 journaling details, date and description, this is the part of the cycle where you'll begin to actually record transactions with this information. Modern software like QuickBooks Online helps save a lot of time, in part, by automating much of this categorization process. Whether you have an accounting software or not, the workflow will still be the same. This workflow will take us from completely uncategorized to completely categorized in 3 substeps. Step 2.1. Determine the start date of the bookkeeping. Typically, the start date for bookkeeping will be the last time the books were reconciled. If the books are new or have never been reconciled, you'll likely start from the last tax return. For example, let's say today is September 1st. If you last reconciled your books for the month of April, then your start date would be May 1st. Why is this? We'll talk about reconciliation soon. A reconciliation is how bookkeepers verify the completion of books for a time period. If the last reconciled month is April, that means the books are correct through the month of April and no further. This means that we start with the next day, May 1st. If there's no reconciliation, we use the tax return, because the tax return is the last time the business's books were verified to be complete. So, to determine the start date, we figure out when the books were last verified to be complete, and then we start the day after that. If there's absolutely nothing, then just start fresh on the first day of the period needed for taxes or legal compliance. In all likelihood, this is probably January 1st for those that need the entire calendar year. Step 2.2. Open the account feeds to the start date. After figuring out where to start, open all the accounts you connected to the business when setting up the books in Step 1, go to the list of transactions, and go to the start date that we just decided in Step 2.1. For example, let's say you have a Chase checking account and start on May 1st. If you have an accounting software, you would connect the bank to that software, sort by the date, and start with May 1st. If not, you would log into the bank account itself and either go to the feed and find May 1st, or download the bank statement and find May 1st there. Step 2.3. Go line by line and categorize each transaction. With the feed open to the start date, it's time to start categorizing. In an accounting software, you would simply select the first transaction for that day, click the drop-down menu, and then select the appropriate account for the transaction, which comes from the chart of accounts you created earlier, creating any new accounts as necessary. You would then categorize each transaction like this until you get to the present day. If you're bookkeeping for someone else, it's very likely you'll need to ask them about certain transactions. Other than that, the process is pretty straightforward. If you're not using an accounting software, you would need to manually write down each journal entry into the general journal that you prepared earlier, being sure to know each of the 5 details required for that journal entry. After each entry, you would then need to transfer it to the ledgers you prepared when you set up the books earlier as well. Repeat this for each transaction until you're current. Regardless of how you categorize the transactions, by the end of this step, every transaction from the start date to the present date will be categorized. Once again, the substeps are determine the start date, go to the start date in the account feeds, and then go line by line and categorize each transaction. Step 3. Reconcile accounts. After categorizing every transaction, you now need to verify that the bookkeeping is complete for that period. You do this with a process called reconciliation. What is reconciliation? Reconciliation is ensuring the transactions in your books match the transactions in your bank and credit card accounts. That way, you know you didn't add or forget any transactions, and it helps verify the accuracy of the numbers in your books. Remember, your accounts will have the true numbers, and your goal is to make sure that your books are accurate to the accounts, but always defer to your bank and credit card accounts, which will have the accurate information. So, how do you reconcile your books? Let's once again break it down into substeps. Step 3.1. Gather bank and credit card statements. Each of the accounts in your business will issue statements at some point during the month. As mentioned before, bank statements typically occur at the end of the month, and credit card statements will vary, but will usually be towards the middle of the month. Reconciliation is largely comparing account statements to your books. So step 3.1 is downloading or printing off these statements. Step 3.2. Compare starting balances. For each bank and credit card account in your business, compare the beginning balance from their statements to the beginning balance in your books for the same starting date and the same account. If they're the same, move on to step 3.3. If the starting balances are different, that means something is off from the prior time period and you need to backtrack and apply the bookkeeping cycle to an earlier period. Now is a good time to emphasize one key detail. Your books are just a collection of all the transactions from your bank and credit card accounts. Therefore, after reconciling all of these accounts individually, your books as a whole are considered reconciled. The key detail I want to emphasize is this. When you reconcile your books, you're reconciling one bank or credit card account at a time until all of the accounts are reconciled. For example, if you reconcile Chase Business Checking 6174 from earlier, you would open the statement they issued and compare it to the transactions in your books from Chase Business Checking 6174. You then repeat this for each account until all the accounts are reconciled. That's what it means to reconcile the books. Step 3.3, match transactions. Start at the top of your bank or credit card statement and compare it line by line with your books. For each transaction on the statement, find it in your books and check it off. By the end, every transaction on the statement should be accounted for in the books. If there's any disparity, it will be with the books. Let's do some basic troubleshooting for any issues you might have. If your books have different amounts, update them with the bank amounts. If your books are missing transactions, add them to the books from the account statement. If your books have too many transactions, see if there's anything still processing in the bank, or if those extra transactions landed in the next period rather than the period you're reconciling. If you still have too many transactions, defer to the statement and remove the extra transactions from your books. Step 3.4, verify the ending balances. After matching all the transactions and correcting any disparities, write down the end balances for the period from both the statement and your books to see if they're the same. If the opening balances are correct, everything is matched and corrected, and the end balances are the same, then you've successfully reconciled the books, and you can mark them reconciled for the period. Step 4, create financial statements. After reconciling for the period, the next step of the bookkeeping cycle is creating financial statements. We covered creating financial statements in episode 5, so if you want to review the process, please revisit that episode. In short, reconciliation is needed to create reliable financial statements, which is why the steps are ordered in this particular way. Step 5, close the books. When it comes to bookkeeping, there are two main reasons to close the books. 1, to prevent anyone from messing up the books later, and 2, to reset the revenue and expense accounts back to zero. Closing the books isn't always necessary when bookkeeping. If you're okay with carrying expenses and revenue balances into future periods, and you don't mind the risk of someone changing past transactions, then it's really only necessary to close the books at year-end for taxes. In accounting software, they typically close the books for you at the end of the year, or they make the process very easy to go through yourself. If you're doing your books manually, though, close the books the same way you would for the accounting cycle. In other words, you journal the amounts out of your revenue and expense accounts and into a retained earnings account. And that's it. After closing the books, you've completed the bookkeeping cycle. The typical yearly workflow for a bookkeeper ends up looking something like this. Start with step 1 and set up the books. Categorize the business's books with step 2 on a weekly basis. Reconcile and create statements at the beginning of every month for the previous month with steps 3 and 4. And then close the books with step 5 when desired or at the end of the year. And with that, let's put everything together with one final scenario. It's February 2025, and the owner of Cookies Galore wants to do their own bookkeeping. They've watched Bookkeeping for Small Business Owners and know enough to go through the bookkeeping cycle, which they plan on doing now. Seeing how much time and effort they can save by using an accounting software, they purchase a subscription to QuickBooks Online. They log into QuickBooks Online and customize their information and then connect all of their business bank and credit card accounts. QuickBooks Online automatically shows them their transaction feed in real time. After this, they go to the chart of accounts and set up the accounts they'll need. At this point, they've completed step 1. Since this is the first time they're doing their books, they don't have any reconciliations. So they decide the starting point will be their last tax return, which was December 31st, 2024. Therefore, they realize their starting point will be January 1st, 2025. QuickBooks uploaded all of their transactions from 2025 when the owner connected their accounts earlier. So, the owner scrolls to January 1st, 2025, and looks at the first transaction. With the owner's knowledge of bookkeeping, they begin to categorize each transaction to its proper account, solving any uncertainty by reflecting on their understanding of the accounting equation. After some time, they finish categorizing their transactions, finishing step 2. With their transactions caught up, they check to see if there are any account statements they can reconcile to. They see that all of their accounts issued statements on January 31st. They download the statements and go line by line and ensure everything is accurate and complete. After doing this, they mark their accounts reconciled to January 31st, finish step 3. Having reconciled through January, the owner of Cookies Galore creates a profit and loss statement and analyzes where they're doing well and where they could use improvement. After that, they stay on top of their bookkeeping and repeat steps 2, 3, and 4 every month, which allows them to have what they need for quarterly tax estimates, annual taxes, loans, regulations, and of course, decision making. At the end of the year, they close out their books for 2025, completing step 5 and completing the bookkeeping cycle. And that's it, folks. You successfully completed the course. In episode 1, I told you by the end of the course, you'd be able to confidently do your bookkeeping, have a professional understanding of bookkeeping, and with that professional understanding, be able to breeze through most, if not all, bookkeeping certification courses. Although this has been a crash course, and far shorter than something you'd find in a college or university, I feel comfortable saying that we covered everything you need to know to meet these criteria. That said, this is only a professional understanding. If you truly want to become a professional bookkeeper, or be at the level of a professional bookkeeper, you'll need to apply what you've learned here, which I fully encourage you to do. And with all that said, the course may be over, but I don't plan on going anywhere. If you have anything on your mind or any questions, go ahead and leave a comment. If you're interested in getting your books taken care of, I'd be happy to help. Go to vitalitybookkeeping.net. Otherwise, thank you for watching and have a great day.